Time for the big three stocks, three charts, three trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades, Don Kaufman, co-founder of Trade. Good to see you, gentlemen, on this Wednesday morning. I feel like it's been an extremely busy week, busy month. And Don, we're going to start off with your Coca-Cola thoughts here. But the big picture is the pressure is on. Don.
Yeah, no, get ready to get bearish once again on a couple of these trades, because quite simply, what's working, just simply keep doing it. On Coke, so I'm actually constructing a bearish put spread on Coke. Nothing too substantial, just one strike in the money, one strike out of the money. Why bearish on Coke? Because it has, well, generally speaking, outperformed. In fact, many of the underlyings I'm about to discuss have just generally speaking outperformed in the near term in the midst of this volatility. And what we're likely to see is high correlation in some of the sell side activity to drag Coke right down with it. This has been used as a defensive stock, but even defensive stocks are looking like they're going to take a bit of a dive here in the near term. This trade, as I was saying, is a put spread. It's a June 17th 65 put. That is buying the 65 put, selling the 62.50 put for about $1.20 debit. Again, it's really void of any volatility exposure. One strike in the money, one strike out of the money, pure directional bet to the downside between now and June 17th.
Yeah, and you know what's interesting here is that you just think it could still get hit here. What happened to Coke and a smile? Ben, what happened to that? Remember the toll booth and the person didn't have a token or something? They gave a Coke and they went right through with the car. Ben, what do you think here when you look at this chart?
Don, Nicole, good morning. I think, Nicole, as Don pointed out so well, relative to the broader market, those that have been holding Coke have had a smile for the most part. I think what Don's saying is it's going to be difficult for them to continue to. Let's take a look at the intraday time frame first and foremost. I've got the hourly here. And you can see the run-up that we saw, a strong move higher, much like we saw in the broader base indices across the board, the ES, NASDAQ, Dow, Russell, throughout the month of March and into April, for that matter. Strength up to 67.20 from 57.50. Here you can see since a bit more sideways. So again, kind of feeding into what Don was talking about. They're struggling to really continue that momentum to the upside, but there has been some momentum to the upside. And well, you not only see that on the 60-minute time frame for 57.50 up to 67.20, but you can also see it on the daily time frame here. This is a look at the pandemic spike low that we saw, the well-defined trend environment that's continued to the upside. So what it looks like to me is we might be just kind of consolidating here. You've got the spike high again, 67.20, the low here right now around 62.50 to keep an eye on, and kind of smack dab in the middle of that range. Now, if it fails, this may end up being a bit more of a V-type top type pattern. We could potentially work our way back in the $60 level. So in terms of that bearish sentiment that Don has, but I wanted to take a step back from the intraday and this daily time frame. And I want to point out here, take a look at some of the movement we've been seeing to the upside here. You can see three areas of consolidation. Now we're going all the way back to the early 90s to look for this, but you can see again, one around this $9.75, $10 level, we'll call it, and then a wider range area consolidation around 30, 35. But here you can see that the pandemic kind of threw everything upside down a bit and, again, shook it all up, to say the least, much like Coke here. You can see breaking out to the upside. I guess the question is this all fizz, or are we going to get some real follow through here? Do we get to see a new area balance form at a higher level? It's in a vertical phase here right now. I think what Don's looking for is for that to fail. So, again, with this well-defined upper extreme 60 that we're breaking out of, the highs pre-pandemic, you're looking for follow through. Higher highs, higher lows, basically the opposite of what we've been seeing in the broader market. So I can agree with Don in many ways in terms of sustainability is tough. Keep in mind, though, some of these staples perform pretty well, or these big names perform pretty well as investors look for individual names to kind of lean on amidst broader market pressures. So this is going to be one to watch here. I like Don's bearish take on this, though.
Yeah, very interesting. And I think that chart that you showed us is very telling. I think you're right. I mean, it really has sort of bucked the trend as we've seen it move from its lows of $52 there up to $67. So even while the market's been so volatile and having a hard time, Don, you still feel like something's coming, huh? It's just not going to be able to withstand this longer and longer.
Well, the reality is that we've actually had some underlyings, specifically some tech underlyings, that have just been far oversold. I mean, I would totally agree with that. In fact, a couple of the underlyings I'm going to bring up over here have absolutely nothing to do with tech, because I'm looking for that kind of quintessential rally. Nevertheless, though, some of the areas, again, like consumer staples, like Coke, they've been bought into as ultimately, duck and cover. Let's protect ourselves. Let's buy Coke. Let's buy Walmart. Nevertheless, even if tech starts to rally, I think you could still see some of these take a hit. And that is a cyclical rotation then out of some of the consumer staples back into a few of the tech companies, which actually describes a lot of the trades I'm actually about to bring up.
Right. Well, that'll bring us to, and we think these staples can sometimes withstand some of this volatility. But here's a name like Home Depot, which was such a darling, went up to this high level of over $400, but terrible the last few months. And you really think it has some downside risk here?
Yeah, absolutely, unequivocally. And I'm sorry to say, but Home Depot, this one is definitely on the dance floor, not just for a move down, but a fairly significant move down is specifically what I'm looking for. So I'm going to ask Ben on this next one. Ben, you got to open up between a 3 and 5 year chart, because when you start looking at it, you're going to, behold, there is huge potential for downside movements, specifically inside of Home Depot. So we're going to hit, obviously, inflationary pressures. And as previous guest was just saying, Oliver, people are literally going to throw their hands up. They're going to stop buying. You've also got higher interest rates, which is actually going to slow the housing market to some degree. I don't know if it's necessarily going to pull pricing back in, but there's no question that there's going to be a demand issue here for Home Depot. So this particular trade is actually all the way out in the July 15th expiration. I've given myself some time because I'm actually purchasing an out-of-the-money put spread. This is going to be a 270 put. I'm going to be buying the 270 put, selling the 260 put, doing it for a $2.70 debit. Again, it's a $10 wide spread. It's way out of the money. It's a lower probability trade. But if this marketplace starts to come apart, I think Home Depot is actually in the next round of sell side activity.
Wow. And, so really seeing that downside potential there. Ben, what do you think? I mean, Don's referencing longer periods of time, looking at long charts, but it's been tough for shareholders because they got excited about this one.
Sure has. Basically a mirror image of what we were just talking about, guys, in terms of Coke and the rally that we've seen there, the strength in KO. Take a look at ticker symbol HD. They have been, KO'd in many ways for the most part. The move we've seen from 417 down to 285. Now, Don, when you're calling for me to look at the longer term time frames, I've already got those queued up, so I know I'm on the right track if that's what you have your eye on, and we'll get to that in just a second. But first and foremost, you can see the trend environment to the downside and how we're now recently trying to break out of a range that's been formed. We call it 340 to 300. Be interesting to see if we can build some momentum here if the broader market continues lower. We know there's headwinds to shares of HD and some of the other names in this space with rates on the rise and a more hawkish tone from the Fed. The housing market, in theory, which is going to, much like Coke, probably have a hard time sustaining the upward trajectory that we've seen with the headwinds that are present here. Here's the daily time frame. So you can see that move lower in terms of Coke as we were looking at. It's just part of the bigger picture. Here's from 420 all the way down to 286, a trend environment, well-defined areas of migration of value. I didn't highlight them in this chart, you can see, but take a look. 410, we formed one around 360. Recently, again, we just talked about the one around 320, and here's, as Don asked for, the 3-year. Look at the weekly time frame. So weekly candles going back to 3 years, and this really spells it out. The migration of value to the upside, 1, 2, 3, 4, 5 forms around that 400, 410 levels I was just talking about. Here's the one we just looked at around 360. Here's the one that we're trying to break out of right now around 310, 320. So you can see, again, shares have lost their momentum at the very least. One could argue trending lower at this point. Lastly, Don, you requested the 5-year look. You can see the move all the way back to, we're talking 2017, June of 2017. They were down around 140 all the way up to 420. So there is some room to run here to the downside if we continue to see pressures. And again, as mentioned, plenty of headwinds. I mean, you could throw a dart and hit a headwind for the housing market in general.
They better find some support because those low levels are way down. I mean, those are an abyss, Don.
Yeah, no, that's exactly what I'm referencing is, I'm at the point where 9-month charts, 1-year charts, they're not going to do it anymore. You got to start, zooming out to like 3, 5 year and recognize that that's what we're in. I mean, listen, there's, every decade or so you get a significant draft, in the marketplace, and that's exactly what you're seeing right now. I mean, this is my house. This is volatility right now, and it's okay to be short underlyings. I mean, we don't necessarily have to be an investor to the upside. We can actually take some short positions. Profitability is profitability.
Yeah, understood. Last but not least, taking a look at UnitedHealth, and you think it's yet to take a hit that it needs to. A massive hit may be coming for this one. Tell us, Don.
So I'm going to give you a little bit of a different take here on UnitedHealth. I am going to take a little bit of a bearish shot in UnitedHealth, and I'll get really specific as to why. The Dow Jones on a year-to-date basis is actually outperforming the S&P. It's outperforming the NASDAQ by a very significant margin. I would anticipate that the Dow Jones is actually going to play catch-up at some point to the downside, at the very minimum, to the S&Ps. And if you look at the Dow Jones, it's down between like 11 and 12% on a year-to-date basis. Well, guess what? Who happens to be the primary constituent? The largest factor inside of the Dow is unequivocally United Healthcare by a large margin. So in this case, I'm looking to the June 10th expiration. I'm going to be buying a 480 put, selling a 475 put for a $2.35 debit. It's just a $5 wide put spread. I'm just going to take advantage of, again, where I think it's less about United Healthcare and more about the Dow, right? United Healthcare just happens to be an underlying that is, as I said, it's the biggest in the Dow. It's the most influential in terms of price point, and would look for a downdraft in the near term for the Dow to actually come back into alignment with the S&Ps.
Yeah, as it is a weighted index, to your point. I mean, it's $495 right now. Ben, your thoughts on this concept?
You know, guys, I kept the charts real clean, real simple here in terms of UnitedHealth. I wanted to point out two things: the significance about being very time frame specific when you're talking about a stock and trying to identify trend. Because take a look here, you can see over the last couple weeks on the hourly time frame, basically the move lower from $550 in the middle of April all the way down to $480 recently. A well-defined trend to the downside, no rejection of this lower level, simply put, weakness. But taking a step back, look at the daily time frame. That sort of spells or tells a little bit of a different story. You can see the trend that we've seen and how these dips that, well, possibly the one we're seeing right now, have been bought. You can also see a couple pretty well-defined areas of consolidation. We'll just kind of call this one around this 345, 350 area. Look at the one that formed around, we'll call it 410, recently forming one around 470. Now, this was a breakout up to $553. You can see, again, out of this range that formed basically since the beginning of the year, February, March, and into the end of March is when we ran them up to that $553 level. A bit of a V-top type pattern. We talk about acceptance or rejection. In this instance, it does look like they've rejected to the upside. Take a look at the weekly time frame. It really spells to the significance of that rejection. Look, if lower this week, we're talking 5 in a row to the downside. Again, simply put here, you know, we talk about the ability to sustain upper levels once you break out, and it looks like UNH has really struggled to do so.
Understood. Thank you both very much. Wonderful to see you on this Wednesday. We'll get that PPI print tomorrow. We've had a lot to take in. Don Kaufman of Trade, Ben Lichtenstein, thank you. Big three every single day. Thank you very much.